Record. 45% of central banks expect to buy more gold in the short term. FTSE 100 rises 0.6%. Bank stocks move higher. Japanese yen. BOJ hike offers limited support to yen. BBH.
Bitcoin price. Forecast BTC rebound driven by fading selling pressure as demand remains subdued. WTI oil hits 3-month lows sub $78 on hopes of Hormuz reopening.
Citi says fade euro rallies if Warsh disappoints hawks. Gold prices inch higher with Iran deal. Central bank meetings in focus.
CAC 40 rises to 2-month high. Indian rupee remains firm on early signs of FII's return.
Australian dollar. RBA pause keeps downside risks alive. BBH.
RBA policy hold underscores growth. RBA policy hold underscores growth slowdown. Société Générale.
Record. 45% of central banks expect to buy more gold in the short term. FTSE 100 rises 0.6%. Bank stocks move higher. Japanese yen. BOJ hike offers limited support to yen. BBH.
Bitcoin price. Forecast BTC rebound driven by fading selling pressure as demand remains subdued. WTI oil hits 3-month lows sub $78 on hopes of Hormuz reopening.
Citi says fade euro rallies if Warsh disappoints hawks. Gold prices inch higher with Iran deal. Central bank meetings in focus.
CAC 40 rises to 2-month high. Indian rupee remains firm on early signs of FII's return.
Morning bid. Central banks take the stage.
Last chance to grab a coffee or an energy drink, or, well, that one's full, or that one. I'll see you in a couple of minutes, eh? Ohio! I'm here. Sorry. I was stuck in traffic. Shit. You guys ready? What are you up to? What are you doing? I gotta pull up the chat. Hang on. YouTube. All right, let me get to the chat. It's easier to see what you're saying when I'm actually looking at it. Eyeballing. YouTube. Cool. All right. G'day, mate. How are ya? How's your mum? I'm going to pop the chat so it's a little easier for me to see. Even better. All right. Well, welcome to Forex.Today, the YouTube community of more than 21,000 foreign exchange traders. We're a collaboration between Traders and Traders Way. Let me remind you that trading is risky, not appropriate for everyone. Past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. G'day. G'day. Let me try the coffee. So good morning. So a week ago, things were terrible. Today, things are great. Which do you prefer? Well, the difference is buying and selling on or off, right? And you're just like, hey, man, I don't really care as long as the market's moving. Yeah. So anyways, hey, you want to do some fundamentals? You want to do some technicals? You want to read market sentiment? Do you want some inside information that is legal and ethical to obtain? Not easy to obtain, but do you want to see what institutional investors are doing behind the scenes? Do you want to trade with them or against them? Well, that's our goal, to be able to look at the data. So yesterday we said there was a 94.7% chance the Bank of Japan was going to raise interest rates. You're like, Wayne, nobody was surprised by that. Yeah, but look. The thing is, we had the data. It's not that they raised and everybody thought they would raise. It's how do you know? So many people just listen to Bloomberg, CNBC, they read something on the internet, and it's like, oh, everybody knows the Bank of Japan's going to raise interest rates. So now you know. But do you know how they know? Do you know how that came to fruition, how that decision was made? And
Philippine peso, US dollar, PHP bearish bias, but risk of snapback. OCBC.
That's the Squawk Box.
Investing live European FX news wrap. Oil prices extend losses as US lifts naval blockade.
Dude, can I talk, please? Thank you. So we looked at the Japanese government bond yield curve. So we didn't need to listen to anybody. We followed the money. Well, I didn't see it on TV. I didn't read it on another website. I have my data. That's it. I have the facts. That's it. I know. So that's the point I'm trying to say. Like, I want you to be the person they turn to and say, hey, what are the expectations that the Bank of Japan's going to raise interest rates? Well, when you look at the yield curve and the change of the yield curve from Japanese government bonds over the last 30 days, the implied interest rate is, 0.98. So there's a 94.7% priced in probability that the interest rate will be raised to 1%. Or you can say, I don't know, I heard it on TV, so I guess that's right. guess. Experts don't guess. Illuminati don't guess. Illuminati is the truth through knowledge. You don't know what anybody else thinks. You don't even care. We measure the data and make decisions. So that's what we do. That's cool. I love what we do, by the way. Love what we do. So these are good times. You are completely independent as a trader. And even if you're trading out of your mom's basement or out of on your kitchen table, you might at times feel small. You don't have $1 billion in your trading account, but the thing is, you're making $1 billion decisions. Yeah. And that's cool. Okay. So let's get an update. Hey, Aiden, what's up?
Good morning, I'm Aiden from Tradars. Let's get you up to speed on the current market landscape. Today's market sentiment is neutral and indecisive, representing a clear divergence from the strong risk-on trend observed over the past month. I'm tracking a slight decline in U.S. 10-year yields, which is currently providing a modest tailwind for equities and gold, while the U.S. dollar trades with a softer tone. 1. Oil is under pressure as WTI hits sub-$78 on Hormuz reopening hopes, while 45% of central banks signal intent to buy more gold. Markets are currently in a holding pattern ahead of tomorrow's UK CPI and US retail sales data. Biggest movers right now, WTI crude oil and Brent crude oil are down, Platinum, Dow Jones, and DAX are up.
Yep. Come on, central banks, buy some gold. Buy some gold, huh? We want central banks to push that sucker well above 5,000. I'm going to sit on it like Mother Goose, and, my bet is 5 years from now, gold will be over 5,000. As long as that happens, I'm smiling. Look at the freaking smile on my face. Cool. So while that's happening, which is interesting, the 45% of central banks signal their intent to buy more gold. Now, that came from him reading the news. So he read that in a news article. I don't waste my time going to other websites and reading. Dude. You're like, really? You read? I don't read. Yeah, so Aiden does all my research for me, which is great. So he read that this morning. So I don't know how it got there, but you can read the article. So I can go to the, because I noticed it's here, this one. Here's the article.
Philippine peso, US dollar, PHP bearish bias, but risk of snapback.
Okay,
OCBC.
So you can read the article if you want.
Investing live European FX news wrap.
Oh, shush. Okay, so that's a new feature. It's on the gym list. And so anyway, so Aiden knows this, which is great. That's where he got it. So it only came out 28 minutes ago. It's already in his brain. There's no algorithm to say, hey, copy the news and paste it in here. No. He read it. This is what's on Aiden's mind. Now, our next step then is to go to fundamentals, go to econ, go to gold radar, and maybe be able to track some of this. We do our best. So gold has been recovering a little bit, but it has been in a downtrend. So I'm going to update the language on this so we don't get confused. This doesn't project. It says projection. It's not a projection per se. I mean, look, it's a linear projection with some standard deviation. So it's more like at this rate of change. The rate of change is negative, and there's a measure of volatility inside that short-term move. And so if you were to measure here to here using linear projection and then put a standard deviation. So I don't know, you could, it's like a projection with Bollinger Bands, or you can say if you clicked here, here, and here, you could do a Pegler pitchfork or something, right? It doesn't mean that's what we think the future is. In fact, we think the future is here. So I need to kind of change that. So we are or have been in a downtrend, but we know things may be changing. Geopolitics may be changing. Monetary policy may be changing. And so it's our job to start watching this maybe flatten out and rise. That's our goal, to be able to watch it happen. 10-year real rate is changing. Okay, so 10-year minus CPI. You might want to take a look and do stuff like this for Australia and maybe New Zealand and maybe the UK and maybe Canada. Hey, Wayne, can't you just have Aiden do all that crap for me? Oh, okay, maybe we'll do that for you. But you want to start watching this kind of stuff as well. But what caught my ear, okay, is that central banks have been liquidating because of more recent necessity in monetary policy, but we may be in a new regime, right? The war in Iran may be over. The war in the Ukraine may be over. Cuba may be liberated. Yeah, the world could get really good, and maybe this changes. I don't know. So we need to watch that. And the article, which I haven't read, but was talking about an increase in buying. Now, the way we get this is quarterly data. It's the only way we can get it. We get it from, well, there's multiple sources. But, so where does it go? Come on, scroll with me, baby. So anyway, here's some recent highlights. And one of the things we might want to track is who's buying and how much and what's the percentage increase. So 45% of central banks around the world are buying. Okay. Who's buying? Now, what we do know is Turkey is selling. Azerbaijan is selling. The Russians are selling gold. Where's it going? Who's the buyer? Is it China right now? No. Poland? The heck, Poland? What are you doing with all that gold? Right? And I'd like to expand this data. When I built this, it was too big and not helpful. And then I gave them some rules. Just show me the biggest buyers and sellers plus the G7. And it didn't quite do it that way, but blah, blah, blah. We're also looking at, this is the production of gold and silver. So production has been falling. Isn't that good to know? I mean, seriously, look, just look at it. There it is. Production of gold and silver is falling. Now, I can't get gold specifically because that's not how it's reported. Now, we have to get it as a subcomponent of the mining and mineral industry from, right, the Federal Reserve Board of Governors as part of the G17 Industrial Production and Capacity Utilization Report. So we're mining the miners out of here, and the most minute detail we can get is gold and silver together. But it's not copper. It's not iron ore. It's not coal. Okay. And I think because when you're digging gold out of the ground, silver is just mixed in there. Yeah. Cool. So anyways, so look, production is falling. Do you think that's part of the reason? Let's just say this goes back to July of last year, so 1 year ago. During that period, gold and silver went up. Well, this is an interesting. We know the price went up, but did you know at that time, while price was going up, the production, the supply was actually falling, or the increase in supply was diminishing? That might be related to price going up. There's more demand, but less supply entering the market. Which means if you want gold, you're going to have to buy gold from somebody who already owns gold. Now, why would they give up gold if they own it? Maybe they want it. So you're like, well, I'll pay you more. Well, they might have bought it 10 years ago for, $650. Do they want to sell it to you for $5,000? Yeah, maybe. Everybody's got their needs. Baby needs a new pair of shoes. She's not laughing at your jokes anymore. So anyway, so we have supply. Isn't this cool? And then this is a form of demand, specifically central banks. But we also like how much gold is being purchased by the technology sector, the jewelry sector, the investments. ETFs is a huge one. I'm a little disappointed on the lag of getting data, but I think that's the best we can do. I will audit this page because I can see right away it's not formatted to full screen as it's supposed to be. So it needs a good old audit and see if I can get new data. Okay. Okay. So here's something interesting. Last week, institutional investors sold gold, but over the last month, they bought about the same. But look at the giant. So that makes this, right? Look at the giant increase in gold purchasing by institutional investors over the last 2 months. This really should be 3 months, not 8 weeks. Cool, right? So there's definitely turnover. A whole bunch of people bought and a whole bunch of people sold, but the general trend is up. I mean, can you guys give me some feedback? Do you even care about this stuff? You're like, Wayne, I don't even trade gold. I don't look at gold. Like, what the heck? You're tracking central bank purchases and sales of gold, and you're tracking the mining and supply of gold entering the market? Like, who cares? Do you care? Just Jim? Hey, well, that's good enough for me. Good, Jim and Denise. Even better. So now we got a whole audience of 2 people. Nice. Yeah. Cool. Hey, man, gold is money. Oil is money. Be interesting to see this continue. Remember, we've been projecting down, way down for a month or two. Yeah, and now we have broken below the old support. Yeah, and Meta. Yeah, and JGB, for sure. Vince is in. Sorry, I was looking over here. So now we're over in the black gold, as they say in Cuba. The gas stations there are called black gold. I'm like, that's so cool. Makes sense. Texas tea. All right, so look at that. Down is down. Remember, these are not really projections. They're trend. They're pointing out the trend, but we've been bearish for quite some time. I don't think it's going to go to $21. Don't. So that's why I'm like, But this gets updated, well, every day when it comes to price, but it's the rig count stuff that's important. Yeah, rig count. Yeah, baby. And this is great too. The GDP. The reason I track GDP for the world, then for the rich countries, okay, poor countries, and China. That's how I broke it down. Because I do think they are different constituencies. Think of the global K-shaped economy. So there's the aggregate. Okay, so growth. Okay. Now, I had a big, long conversation with Aiden, and this was, I don't know, a year ago now. And his brain is so much smarter now. I should probably revisit the conversation, but I'm like, dude, you projected slowing. Why is there higher demand? And he's like, well, it's slowing, but it's growth. 3% growth for the entire world, even if it was higher, so it's absolutely a little bit slower, but relatively still huge. Okay? Huge. He's like, that is a good number all day long. So higher demand. That's what it's reporting. Which means it's not a simple algorithm like, oh, well, if GDP is falling, then that says falling demand for energy. Well, he overrides that and say, yeah, well, it's falling, but it's still a massive number. Oh. Okay. Plus, I believe there is a little bit of projection in there from so we're getting this one from EIA. That's interesting. I thought we were getting it from somebody else. Well, the EIA has some projections in there too. So anyways. Now, who is demanding this? Okay. The rich countries seem to have high demand and it is stable. So even though maybe our economies are, let's say slowing down because of geopolitics, high prices, blah, 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 it is stable. It's not crashing. This is another way. Well, this is one tiny little way to get, a third party opinion here. No, it's going to be biased because it's a U.S. government agency. But I hear a lot of people when I go through the world tell me that the sky is falling and the economy is about to collapse and the dollar is worthless and the whole world's going to crap. And I'm like, maybe is the best way to respond. You're like, oh, that sounds terrifying. But then when you look at things, you're like, well, if you look at the facts, there's no indication that the world's going to collapse. Okay. So maybe it will collapse. It's just not collapsing yet. So anyways, so the rich countries are actually stable and about normal. We want this a little closer to 2%, but we do know that 1.6 for mature economies is about right. And then for catch-up economies, non-OECD, so the younger, smaller, more maturing, right? This is a normal rate because remember, it's like, how do we say it in reverse? And I'm going to insult people, but it's easier to lose 20 pounds when you're 200 pounds overweight than lose 20 pounds if you're 5 pounds overweight. So there's this same idea in reverse, though, that if your economy is already massive and you got bridges over every river and you got airports at every city and all your roads have been paved and all your rail lines have been made and all your ports for airports and seaports, they've all been built and dredged and paved, and you just have all this infrastructure. Well, if you use the solo growth model, which I teach in the economics class, you'll know that at some point when you're hugely rich like that and you've already built all this infrastructure, most of your money goes to maintenance, what we call depreciation. So you're not building more bridges, you're just rebuilding the old ones or maintaining the old ones. You're not building more airports, you're just fixing up the old ones. You're not building new seaports, you're just improving them. Your roads you're repaving. You're not building new freeways, you're just repaving the old ones. So that's all maintenance. So your growth doesn't go up. You're spending all your money on maintenance. It's like you're rich and you got 9 Ferraris. How come you can never afford the 10th one? Because it's so expensive to have the other 9 Ferraris. Oil change, $5,000. Tune up, $25,000. You're like, but I've only got 3,000 miles on it. Uh-oh, a hose has cracked. Put in a new rubber hose, $5,000. You're like, for a rubber hose? Yeah, well, it's a Ferrari, right? Yeah, I got you, HDO. The thing is, I don't stare at the comments, right? But anyways, so there's this idea of catch-up. Because if you're a young country or a maturing country, you're building your first real airport, right? You're building a new highway. The new highway is way more productive than maintaining the old highway. A new bridge is massively helpful to be able to cross the river, compared to the time when you had to go around, 30 miles to the other bridge, right? And so there you go. You can see that growth will always be higher for non-OECD. But that increase in improvement will say, well, now, we can have more usage, more demand because they're more productive, right? And then China's China, dude, we need to know, right? Oh, you're answering the gold. Yeah. Oh, I see. You had to speed up. Yeah, YouTube is strange, isn't it? All right. Do collectors spend a lot on maintenance? Oh, you mean of cars? Well, I was racing vintage Lotuses in the Berkshire Hills of Connecticut, and I was in the paddock at night, and we had a little fire going, and I had a case of wine with me, and some dude, a racer from another team came by, and he's like, "Hey, man, you mind if I can get some wine?" I'm like, "Pop a squat, let me get you a glass." Yeah. So we were talking, and I said, "Where's the accent from?" He's like, "England." I'm like, "England." Right? Down with the king. And I said, "Oh, so you live here?" And he's like, "No." I'm like, "Oh, so you're just here to race?" And he's like, "Yeah, but um I keep my cars here, my collection." I'm like, "Oh, you collect cars? Like, what do you got?" "Ferraris." Like, "Oh, yeah, vintage Ferraris. How many do you have?" 300 here in Connecticut. I'm like, "Wait, you live in England? You live in London?" "Uh-huh." "And you have 300 vintage Ferraris here in Connecticut?" "Yep." He's like, "I rarely even see them." I'm like, "Well, dude, where do you put 300 Ferraris? Like, did you start a museum?" And he's like, "No, no, no. We bought a World War II canning factory where you have basically like huge windows along the side. It's long like a football field. And then it's even got a glass roof, right? Because back then they didn't use electrical. I mean, they could have done electrical lights, but you get natural light in. And it's 2 stories, and the elevator's big enough. He said he bought this thing because the elevator is big enough where you can drive a car into this industrial elevator and go up to the second floor. And so he's got a full-time staff, full-time mechanics, and this huge building with all his Ferraris. And he visits maybe once a year. He doesn't even know what's in there. So, what's it cost for maintenance? This guy spends millions of dollars just storing his cars. So, you know, and so I even met his mechanic, and the mechanic was complaining about this billionaire because, he'd get a phone call in the middle of the night, and he's like, you know, I need, I need 30 million now. Sell something, make it happen. Let's go. I don't care what you sell something that's going to move. I need the cash, because you're a billionaire doesn't mean you have cash in the bank. You're always cash short because everything's invested, right? So anyways, he's like, I need 30 million now. Move something. Let's go. So anyways, yeah, what you spent? Yeah, he spends. So yeah, this is I'm telling you, by the way, life for people like that is different. Yeah, life is different. So, anyways, going back to the normal world, what we're trying to do is identify demand, future demand, and so we need to update all of this as the data becomes available. I looking at this, I thought I asked him to also incorporate the World Economic Outlook. Do you guys read the WEO? Aiden does. I do, although I haven't personally done it in We used to do it all the time, actually. We used to even trade the WEO. I'm just trying to pull up the. Should be the right one. This is great. Mm, mm, mm. So April was the last one. So the next one's coming out very soon, I think. And in here, we are able to get. Oh, look at that. It's not allowing me to. We are able to get GDP. I'm going to stop this. GDP projections. So this should have multiple sources because what I intend to do is say, projections to 2027, 2028. Yeah. And so this should be updated, maybe including the WEO. But do you see what I'm trying to do? So there's supply and demand equations going on. You need to know the supply side and the demand side. This is important if you're going to understand monetary policy. And our current situation, you've heard me say 100 times, the Fed shouldn't raise interest rates. Because think about what the central bank can control. Does it control supply or does it control demand? Does anyone want to take a guess? What can the central bank of a country, of an economy, control? Supply or demand? We have one vote. Anyone else? You better not vote. You don't want to look stupid on YouTube. What would people think of me? Yeah. Come on! Type in a question mark if you just have no freaking idea. Okay, well, I'm going to go ahead and answer. All right, let's do supply. There's not enough aluminum doors in our economy. Therefore, your new garage door is expensive. What can the central bank do about it? There's a bird flu hits our chicken farms in the United States, and millions of chickens have to be destroyed. What does the central bank do about it? Yeah. A series of tornadoes and massive storms move through the Midwest, destroying wheat crops and corn crops. Luckily, God saved all the sorghum. So wheat and corn supplies have been diminished greatly and will take a year to replenish. Therefore, supply falls and the price of wheat and corn skyrockets to unbelievable heights. What does the central bank do about it? The Strait of Hormuz is closed because of geopolitical conflict, and 20% of the world's energy and related products have been taken out of available supply, and price skyrockets, oil doubles. What can the central bank do about the lack of supply of energy? The central bank cannot do anything about supply. It can't force copper mines to produce more copper. The copper miners are like, but there's no more copper. Well, we demand you get more copper. But we're digging. We're digging as fast as we can. There ain't no copper. Well, we demand more copper. Well, they can't do anything about it. You just can't do anything about it. Yeah. Okay, so let's say all this stuff happens. and happens all at the same time. Yeah. Well, now you have demand fall if farmers are going out of business and all this kind of stuff. Well, let's not go that way. Let's go this other way. The economy slows down because the cost of borrowing is very high. We just went through a giant boom period. And because of AI and robotics and the electrification of old world industry, suddenly we're utilizing space, outer space, in ways that we never dreamed before. Cool. So the world goes through this massive, second version of industrial revolution. Everything that we know to be true changes. Well, we have the United States, instead of growing at 1.6, it starts growing at 3.5. And the economy is booming, and everyone that wants a job has a job, which is okay. And all of a sudden, that creates inflation. So the Fed could address this growth, because remember, there's the way that the Fed does all this is that we have business cycles, right? You have a boom and then you have a bust. And what the Fed is trying to do is this. Okay? So this is potential GDP. And then you have actual. Okay, potential and actual. I should have done GDP and GDP actual, but anyways, GDP. I'm committed now. And so it's normal for the economy to go through boom and bust, boom and bust. JGB says, hey, so no money available to address the production issues. Okay, here's $1 billion, JGB. Increase the supply of oil now. But you can't, the $1 billion wouldn't open the Strait of Hormuz. The $1 billion wouldn't drill oil wells up and running today. Now, that would be, let's say, a longer term investment, but that's not what the Fed does. Now, maybe the government, JGB, says we want to have energy independence, so we have decided to make permitting easier, and licensing and regulatory compliance issues easier in the United States, so that our cost per barrel to produce drops, because it is a national best interest to produce more energy and gas, so we'll make it easier and cheaper and faster to produce. Well, that's a government thing. But the central bank is addressing growth and inflation, which would be different, right? So what the central bank is doing is this: potential growth. They're trying to smooth out the boom and the bust. So in a period like this, the central bank is raising interest rates because we're above potential. So potential traditionally is around 2%. Okay? So right now we're at 1.6, so we're about here. Okay? But when the economy is booming, they're raising interest rates. And then what happens is you get to a point in which interest rates have cooled the economy down. Right? Now, Trump is arguing, like, why would you do that? And, well, that is an esoteric question. This is philosophy. This didn't exist 150 years ago. And even for the longest time, even more modern, like like the current Fed, built by J.P. Morgan, and the Bank of England, who was run by J.P. Morgan's dad. Dude, interesting history, huh? Yeah. J.P. Morgan's dad sat on the Bank of England's board. Dude, it's an interesting life. Anyways, the current policy is take out the peaks and valleys. Okay? And you raise, and then you cut. In particular, you start cutting when you drop below potential. And so this is kind of an interesting period here. So the Fed can raise, and every time they raise, as I have mentioned to you many times recently, the cost of doing business falls. Sorry, the cost of business rises, your profitability falls. It's kind of like a tax. Okay? But the central bank doesn't tax. It makes the cost of borrowing, which is a normal thing in business. Right? Like, imagine you're General Electric and somebody hires you to build a nuclear power plant. It's going to take 10 years and $150 billion. Cool. So how does General Electric pay the bills, pay the workers, buy all the material if it's going to take them to 10 years to deliver the product? So it's totally normal to finance the thing. Well, when this borrowing gets more expensive, you're less profitable. You remember when you could get a car loan for cheap? And then after COVID, a car loan was 9%. Now you can get a car loan for, I don't know, 4 or 5% again. but there was a time when car loans were free. Like, do you want a free car loan or do you want a 10% car loan? Do you want, like my mortgage is 2.9 and now they're 6 or 5? Which one would you prefer? What changed? Monetary policy. So if your mortgage is 5 and mine is 3, and let's say that makes your mortgage payment $5,000, my house is bigger than your house. We spend the same. The value might be right, or the monthly payment might be the same, but the houses are not equal. So this is what we're talking about here. So they raise. Your house is getting smaller and smaller and smaller. For, let's say $1 million buys you less and less and less and less and less because the cost of borrowing. But also imagine every company that leases equipment, leases vehicles, leases plants and equipment, that kind of stuff. All the companies that issue bonds in the bond market, they all have to pay more, which means their profits are less. Okay, so that's what's going on here when the Fed is raising. That can slow down demand because you have less disposable income. Think of profit as disposable income. If you're a company and you're like, well, revenue's the same, but interest rates have gone up. So last year we had $1 billion in profit. This year we only have $750 million in profit. Where'd the other $250 million go? The cost of financing your business. You just don't have that $250 million. So now this year you have $250 million less to spend and invest. Well, what if your payroll is $250 million? Well, you can give all your money to your employees, but now who pays the rent? Who pays for the electricity? Who pays for the product and development? What about the rainy day fund? So now you're like, dude, I got to lay some people off because that extra $250 million not in our pocket is a big deal. And the only thing that changed was the cost of doing business. And then you can vice versa, make companies more profitable by saying, look, we know you're going through a tough time. The economy is down. So imagine we're in, let me do it in yellow. We're in this kind of section here. Okay. And the government comes along and says, hey guys, we know you're going through tough times. Okay. So we're going to lower your cost of doing business. We're going to make it cheaper for you to borrow. We're going to make it cheaper for you to lease. And we're going to entice you to do projects that you put on hold because they were too expensive up here. So we're going to make it cheaper. So now we're going to move it to this, right? We're going to make it cheaper so you can do that project. You planned it here, then the cost went up, so you're like, put it on hold. Now the economy dropped, the Fed makes everything cheaper, and now they're enticing you. They're like, dude, if your borrowing costs drop from 5 to 2.5, could you do the project? Could you build the factory? Meanwhile, wages have fallen. There's lots of bulldozers not being used because a lot of these projects have been mothballed. So the supply of bulldozers have gone up. So the cost of renting bulldozers for your project has fallen. So your labor is cheaper. Your tools and equipment are cheaper. The land is probably cheaper, and the cash, the actual money, is cheaper. And that's why you go through booms. So now this is your boom, and then now everyone is building factories, especially the ones that are not that smart. They wait until after, right? After we're in this upper period, and then they start building factories. See, they're doing it late. They had no foresight. So now up in here, when money is expensive and the land is expensive and there's not enough bulldozers to go around, dum-dums start pouring money in here. Now, remember, they're dum-dums because they're building when the economy is booming. They're dum-dums. Yeah. Now, it's interesting because I'm an economist, right? But I studied finance at Harvard, right? I have a graduate degree in finance, right? So I took 2 or 3 classes on real estate finance. And this whole thing was covered in real estate, but from a completely different view. And real estate works slightly different than sort of the general economy. And so what I'm talking about here, when I'm like the dum-dums are doing their projects during this boom period. Oops, that was one too many. Trying to get rid of that. Yeah, so let me highlight it here. If you're doing, there's a lot of stuff getting done in this period. I have to reiterate, during this period, the economy is booming. But there's not enough workers, there's not enough land, there's not enough equipment, and the cost of money is high. And I say dum-dums because somebody goes out and says, dude, everyone's rich, everything's booming. Yes, I know everything. There's a scarcity of everything. Therefore, everything's expensive, including money. But I'm going to do it anyways because it can only get better. Yeah. Now, the smarty pantses try to figure out this period here. You don't want to build on in this period. You want to build on this period because interest rates are still at 0, right? The Fed's cutting interest rates during here, and then we trough and it starts improving, but the Fed hasn't raised interest rates. They don't raise interest rates until they're above potential GDP. So you're getting cheap money. But we just hit the trough of the recession. So land is cheap. People need jobs, so wages are lower. There's a surplus of everything. You need new tools. You need new trucks. Dude, go get your Ford F-150. You can get one for 0 down and 0% financing. Go get a whole bunch of them. Okay? And same thing here. When you get to this point in real estate, everything is booming, right? Your apartment, which you have a cheap mortgage because you built it here, 100% filled with tenants. And rents have been going up, not down. Yeah. You know what you're supposed to do? Sell. Sell at the top. Now remember, we're doing finance and we're doing the business cycle, but real estate people are not necessarily the same as economists and other types of financiers. And so the interesting thing is if you combine what we do with the real estate cycle, very often the real estate market is ahead of the general economy. That's the cool thing. I guess if there's any cool thing about having too much education is to see the overlaps and the differentiations between the similar types of analysis. So the Fed hasn't started cutting interest rates yet. No. Jobs have not been lost yet. GDP isn't negative yet. Everything is awesome. So you should sell. But there's a way to analyze when. Okay? And it's the peak in the trough, right? Like falling, but stable. Rising, but not like not falling, but not rising, right? That kind of stuff. So anyways, all of this is impacted by the central bank. To wrap it up, the central bank has no control over the supply. They can only control demand. See, at some point, if the economy stabilizes and people are like, hey, wait, we're not booming anymore. We're not collapsing, but I don't have as many tenants showing up trying to get into my building. Then you start hearing about one of the companies in town is laying some people off. Too late. You can't sell the building. No one's going to buy it if financing's high and everyone starts to think the economy is slowing down. It's too late. You need to already have liquidated. So now you got this boatload of cash. You sold at the peak for the highest price, and now you hold and you don't wait for the Fed to cut, because the Fed cuts here. What do? You wait for the Fed to stop cutting. Ha! Hoo-ha! Bad man. Yeah. Yes, that was sent of a woman. I hope you caught that. Cool. So this shows you how, if you take this, and you're like, Wayne, I'm not doing real estate. Well, no. Well, then think about it a little bit. How does this impact a small manufacturing company? So a friend of mine has a small manufacturing company. Yeah. So when we talk, I'm like, hey, man, how's things going? He's like, I'm sweating bullets. I bought 2 tons of aluminum, and it's sitting in my warehouse. 2 tons of raw aluminum. But he's British, so it's aluminium. But anyways, how does it impact if your cost of doing business is going up, but revenue is flat? You're actually less profitable, and you're sweating bullets like crazy. And right? And that's even when demand is steady. So the central bank cannot control supply, but they can help influence demand. Raising interest rates slows the demand down, and cutting interest rates entices to invest. Or how about this? Let's look at a different constituency. Do you put your money, do you save your money or spend your money? Okay. Let's talk about this, for example, because it's tied to the same thing. It's just a different constituency. The Fed raises interest rates to 10%. Where do you put your money? Where do you put your savings? Talk to me, Goose. This is behavioral finance. The Fed just raised interest rates to 10%. That'd be a shocker tomorrow, right? Where do you put your money? Bank? Treasuries? Stock market? What did the stream end? We've had YouTube issues last few weeks. Every once in a while, YouTube just drops. Did I lose you guys? Must be a terrible lag today. Come on, YouTube. It's a bit of a problem, YouTube. If you don't know, type in a question mark. Yeah, thinking is fine. Well, Brian, you can't say buy the best deal because that's so vague and generic. Just in general. You have to think, well, what would happen to the stock market? Okay, besides, well, okay, so the stock market, as I just described, the cost of doing business skyrockets, and many companies only have a 5 to 8% profit margin, right? But your cost of borrowing just went to 10%. So most companies in the United States would actually be unprofitable. What happens to the stock market? If the majority of companies in the United States are unprofitable, 1 quarter of negative, 2 quarters of negative, we're in recession. It's just too expensive to do business in the United States at that price because it's price of money. So, what's the opposite? Because the stock market would fall significantly if the majority of companies are no longer profitable or at best treading water. Okay, but you could buy a treasury that pays a high yield. So if the Fed funds rate is 10, your 10-year yield could be pretty good. Could be 11 or 12. Or you could just keep your money in the bank. Because bear in mind, if the stock market is crashing because companies are unprofitable, you just lost your job. How do you feel about risk? You want to invest in the stock market that's falling and you just lost your job? Now you have to decide, do you want the treasury? Because now you're basically losing liquidity, right? You're losing liquidity. You can lock yourself into a 10-year T-note that pays you 5% a year, 12% a year, or you could just leave it in the bank and earn 9 or 10. And you're sitting on the cash. They're paying you interest. Okay? So now is the extra 2% worth the illiquidity? You might say, I want to stay liquid. I don't want to buy a CD, a certificate of deposit, that locks me up for 6 months or 12 months. Like, what if things go bad and I can't make my mortgage payment? I don't want to lose my house. So if I can get 10 by holding cash or 12 by holding a CD, I'll stay in cash. So are you buying cashmere sweaters? Are you buying new Rolex watches? Are you buying a bigger house? Are you buying a new car? Are you going on fancy vacations? Are you going to start a new business? Are you going to build a new factory. No, 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 and no. So you're in kind of a M1 or M2. You're in different forms of cash. Now, treasuries are quite liquid, but the value of that treasury may fall. It might rise, but it may fall. So there's a risk to that. That's why it pays you a premium of 2%. Aha. So you have M1, you're in cash, or you're in M2, you have something near cash. It might be M3, but it's like M3 type stuff lose value really quickly in a down economy. Okay? You guys have heard all my stories of 2008. I bought a $100,000 car for $27,000 in cash. Yeah. I bought a house for 60% discount because I had cash when people couldn't get credit. Imagine the rich person that has a big lake house and a fancy speedboat so he can go out with his kids and do wakeboarding, and they got big speakers on it. Yeah, we're wakeboarders. We're loud and obnoxious. Like, all right, when the economy crashes, because he's rich, but he doesn't have any wealth. So he spends a lot on his lake house, right? Spent way too much money on his stupid boat. Has no savings, no retirement account, but lots of cool toys and a big fancy truck. When the economy collapses, I buy his lake house, I buy his truck, and I buy his boat for 30 cents on the dollar. Because wealth is created in this period. Oops, that was supposed to be a marker. In this period, guys. This is smart money. Okay, think of it. The lake house, the boat, and the truck. 30 cents on the dollar. 50 cents on the dollar, depending on the situation. Everything is cheaper here. Yeah. So this is when you buy. I kind of talked about this yesterday. This is the time of year I like to buy cashmere sweaters for the winter. It's almost July. It was 92 degrees the other day and humid as heck because it rained all night. It rained here for like 10 days straight. And then all of a sudden the skies opened, blue sky, red sunshine, and it's 92 degrees. And the ground is saturated with water. Do you understand the amount of humidity? Yeah. And it actually, across the United States, it was very, very hot for about 5 days. Go on Amazon, start buying cashmere sweaters and ski jackets. Okay? Demand is low. Prices are low. Yeah. Don't buy your sweaters in the winter. Don't buy a house in a good economy. Don't spend your money. Invest your money. And so now we're talking about personal finance versus the business economy versus the entire economy versus real estate investing economy, and they're all intertwined. There's no difference between a business cycle and a seasonal cycle. You have to put the financing part in and say, well, I know it's hot in the summer. So buy winter clothes. And don't buy shitty winter clothes, pardon my French. Buy beautiful quality. Invest into beautiful quality clothes at half price. When the economy is down and money is cheap, borrow as much as you possibly can. And I talked about this. I'm not backtracking. When we were in the worst of 2008, when we were in the worst of COVID, I gave all these same speeches. Borrow as much money as you possibly can and get the best you can for cheap. It's called an investment. Yeah. But you have to know, okay, let's do it in yellow again. Not before the yellow line, after. Yeah. It's cool, right? So, the Fed cannot control supply, but it can influence demand. It can't force you to buy, but the cheaper money gets, the more you're enticed to take the chance, risk on. This is why we have core. So when you look at core CPI or core PCE, some people say core PCE takes out the volatile prices for food and energy. We've all heard this a million times. That's dumb. That's not why they do it. So whoever said that didn't actually understand monetary policy. So why do they remove it? Because the Fed or the central bank has no influence on the cost of wheat or the supply of oil. So they strip it out because it's not based on monetary policy. They don't impact or influence supply. Now, JGB was going on an angle, and this is the hardest part about economics because you can get sidetracked so easily, and it becomes, I mean, I've spent hours trying to break down puzzles, in grad school where they're giving you all these charts, and all of a sudden you can, right? But anyways, this idea of does cheaper money entice you to build another copper mine? Well, it certainly helps, but there's such a lag to that. If it's cheaper to borrow money, will you drill more holes in the ground to suck oil out? Maybe, but it's also very indirect. It doesn't instantly do it. But raising and lowering interest rates does impact immediately your decision of leave the money in the bank or spend the money. So how about this? Let's reverse it again. Your bank pays you 0 interest. You have no incentive at all to keep money in the bank. And at 2% inflation or 3% inflation like we have now, you'll actually lose money if you leave it in cash. You are incentivized to convert your cash into a real asset or a financial asset. So you're like, well, I'm making no money in the bank, so I might as well buy a house. It is, JGB. I 100% agree with you. It's a real challenge. Yeah. But it also has to do with time frame, right? So how about this? If the central bank lowers interest rates, does it impact a farmer to choose to plant more wheat and less corn? No. If money was cheaper, does it entice a farmer to buy more land? Let's say his neighbor's retiring. Does he buy his neighbor's parcels too? Maybe. It certainly makes it more affordable, but it also has to do with the price, and the price is the supply and demand, and so it's very indirect. The reason stimulus checks were used during the COVID crisis is Claudia Sahm suggested that the fastest way to make a difference, because remember, the world was collapsing because of the pandemic, and we needed to save the economy as fast as possible. So you can cut taxes. How quickly does that impact the economy? You can give a tax rebate. Well, that comes out in April, and it's just a tax rebate. And what about all the people that don't pay taxes? The government want to, for some reason, give them even more money. Okay. But what we do know is the velocity. If you give someone $100, okay, it gets put in the economy instantly. Now, there's two types of people, let's say. Or actually, you don't have to say, I mean, there's many, but I was going to say poor versus rich. But, there's middle class, upper class, all that kind of stuff. Now, I always argue we don't have middle class anymore. We have rich, and we have poor, and then we have people not in the labor force. But whatever. So you can break it out any way you want. If you give a rich person money, they already have money. What are they going to do with this new money? Well, just put it in the bank. You don't need it. Well, what if you need food? I don't need food. What about your rent? I own my own house. In fact, I own 5 houses. So you're like, I don't know what to do with this money. I don't have a need. So I'll just put it with my other money. Park it. Nothing happens. Someone that's poor. So again, I'm just breaking it down binary. The economy is not binary, but let's make it binary. You're either rich or you're poor. A poor person, you give them $100 and they're like, oh my God, I'm going to buy gasoline with this. Oh my God, I'm going to hire a babysitter. Oh my God, I am going to buy groceries. Oh my God, this is going to rent. Oh my God, I needed this money because I owe. Boom, it's spent. Fast. Now, because I'm an economist, I understand this, and I understand why the government, actually I don't, but the government actually gave my family stimulus checks. They did. I don't even know why. We didn't ask. We didn't fill out forms. I know other families too, and it's interesting because they own a bunch of real estate. And you don't make money in real estate. You depreciate, which is great. So they have no income. They're very, very wealthy, but they have no income. So they got stimulus checks because they make no income. Also, their children got cheap school loans. And this bugged me. They got cheap school loans to go to university. because of how poor they were. Because poverty is defined by how much income you make. Well, they own 9 houses, paid cash for them. They have no income. They're poor, according to the government. They own 9 houses. And their kids got low interest loans to go to university. I'm like, mother. Anyways, it's how the world works. Right? So, so I realized, like, oh my God, I got thousands and thousands of dollars from the government. They just showed up. The first one, I actually got a physical check. And then one day, my wife found a deposit in our bank account, and it was from the government for thousands of dollars. Like, dude, what the heck is this? So it was weird. So I know as an economist, the purpose was get the money into the economy and save the economy. So as soon as we got this money, we went and spent it all. I was tipping 50%. I was thanking people. We went to a hotel. There was no one to clean our room or towels. We went to restaurants. There were no waiters. The cooks were not even real cooks. I think the cooks took the time off and the waiters became the cooks. So we'd get burnt food and it was just terrible service and bad environment, tipping everybody 50%. And we put it all back into the economy because that was the purpose. And so you can see, like, there's different velocities of impact and different responses. So you could do a tax rebate. It's not going to affect everyone. It'll be very slow. Right? You can reduce taxes. Okay. Reduce gasoline tax. Let's say the feds removed 40 cents out of the gasoline taxes. Okay, that would be an immediate impact because we all buy gasoline and we buy it a lot. But if they made apples cheaper, less of an impact, right? So there's timing and impact to all of these decisions. The problem with the stimulus check idea that Claudia Sahm came up with, I mean, yes, it's an instant impact, but there was no productivity. Okay. So now we have debt and we borrowed all the money. The Fed didn't print the money. They borrowed them. So now we have debt and there was no productivity tied to this debt. We didn't build factories. We didn't build roads. The number one use of the 5 trillion of stimulus checks, the number one use was food and beverage. So the food and beverage you ate and drank are gone. But we still have the debt. We're not even paying the debt. We borrowed the money from foreigners and gave it away for free to create short-term demand, which it did do. That hotel I went to is probably still in business. We paid full price. We showed up. There were no bellhops, right? There was one person at the front desk. It took forever to check in. No room service, no room cleaners, no nothing. And we paid an extraordinary amount, but it put the money into the economy. And guess what? The person at the front desk kept their job. The landlord, I don't know, but we put money in, you see? So it happened quickly. And that hotel is probably still in business. And the restaurants around that we went to are probably still in business. So I did my job. My job was to take all that money and give it into the economy. But now the economy, not because of me, but somebody borrowed the money and then gave the money to me for free. And then I gave it to somebody else for free. The Fed doesn't issue money. It issues credit. And credit needs to have a return on investment. And credit can be added and credit can be removed. Debt, you have to pay back. There's only one way out. Raise taxes, pay down the debt. That's it. Or, actually, I should say, so there's another way. Have a huge booming economy. So let's say we go Trump's way. Trump says we're booming, so cut interest rates. Make it boom more. Okay, that actually makes sense under one condition. You pay down the debt. You don't tax the economy by raising the cost of borrowing. You tax the economy by removing cash from it. So there isn't a tax on borrowing money. There's a tax, actually a tax, that the government removes money from the economy and does nothing with it except pay down the debt. I'm actually all for that. Imagine your credit, right? Imagine your credit score if you're making more and more money. Every year you make more money. You keep getting raises or your business is successful. So you keep making more money. Meanwhile, instead of buying expensive houses and expensive trucks and expensive boats, you pay down your debt. Your credit score goes through the roof. Your debt to income ratio is stellar. Yeah. So I would go that way if I were president of the United States. If I was president, I'd be living fat. If it was up to me, I'd paint the White House black. Sorry, I was quoting somebody. I don't even remember who. So that's what I would do. I'd actually lower interest rates, raise taxes, pay down the debt. Because I know if we drop interest rates to 1%, that would be expansive, and we would go over potential GDP. Remember potential? Stupid drawing. Okay, so you have our business cycle. Come on, drawing tool. Okay, business cycle. That's GDP. And then this is the potential. So in this case, money would be so cheap, you would expand. So instead of raising interest rates to slow the economy down, you raise taxes. Then you take 100% of this new additional tax and you pay down the debt that you took on during this period. When the economy was cold. Okay? The government comes in and tries to influence the economy to spend. They're trying to create demand. But here, paid back that debt and debt previous to that, because we got a lot of debt from previous, and just say, yeah, okay, taxes are high, but the economy's booming. Okay? And just keep it so that we're growing but never collapsing. Now, some people that say get rid of the Fed, well, if we got rid of the Fed, we'd have to do we wouldn't do monetary policy, we'd do fiscal policy. Pure. The government's not very good at it. It's terrible. I mean, you know, the government sucks, right? So that's why you need an independent body. But Congress can raise taxes, not the Fed. The Fed issues credit, and they can take the credit back, and they can add credit. They need the economy to expand, make credit cheap. They need the economy to cool off, make credit expensive. They can buy bonds, but they can also sell bonds to control the precise interest rate. Easy peasy lemon squeezy. Right now, we have ample reserves, which is a whole different mechanism. And it's not actually buying and selling of bonds, which is kind of interesting. The Fed uses an arbitrage system. Okay. Okay. So that's the benefit of having a central bank. They can issue credit and remove credit. It's just that easy. With debt, you're borrowing, you have to pay it back. That's very difficult for a government, isn't it? They take on more debt, but for some reason they don't pay it back. Now, I know this was a long conversation and probably not what you expected, but we talked about consumer behavior, about real estate investor behavior, about business and business cycle behavior. We talked about monetary policy behavior. We've talked about fiscal policy behavior, all around the idea of cycles. And many cycles are related but don't quite overlap. And we also have super cycles, like the 8-year cycle of these cycles, 12 years if you're real estate. So now you have cycles of multiple cycles. For example, the 4-year election cycle. There's presidential elections every 4 years. There's midterm elections every 4 years. They don't overlap, so every 2 years there's elections in the United States. Does that impact our cycles? Yes, it does. But also, a president can be president for 8 years. So yes, the presidential cycle of 4 years is important, but the idea of the increase in importance over continuity. So you could have a party and a president for 4 years. If that person then wins another 4 years, it's a modest change and should have a modest impact. But no, at the end of 8, there's a break of continuity. And so now you have that cycle. Okay. So this is why we look at yield curves, by the way, because then you look at this and you see bonds and treasuries are impacted by these cycles because these cycles impact monetary policy and fiscal policy and consumer sentiment and spending, which, right? Because you're either spending your money or you're saving your money. Why are you spending your money? You can't earn any interest in your bank account. Why are you not spending your money? Well, because you're terrified of losing your job and you're earning 10% in the bank. So you're incentivized to keep it. This is why every day we look at this and say risk on or risk off. And this is why we say risk on today, risk off this month. Because the timing of this is the cycle, right? You can have situations where it's risk on this month, but it's risk off today. Yeah, well, where in the cycle are we? Is it a short-term dip into a long-term rip or vice versa? This is challenging. Long run, short run. Some of these cycles, like I said, real estate cycle goes out 12 years. And so I've studied that down to the nth degree. Yeah. So this is why the wealthy actually do really well in recessions. They have credit because they have a lot of income and no debt. They own a lot of assets. Okay? They don't own a lot of TVs and tchotchkes. I don't think billionaires collect salt and pepper shakers. Right? They collect apartment buildings. And then they know when to liquidate and go into cash. And then you know cash is king, right? When the shit hits the fan. That's when you have good credit and cash on hand. Because you have good credit, but you may still not be able to borrow. Or if you say, well, the economy sucks, this asset is half price, I have great credit, I have great cash, but they're like, we're not lending credit right now. Everything's just frozen in this market. You're like, well, I'll pay 50% in cash, and then you lend me the other 50% at extraordinarily low interest rates. And then when the economy improves and credit is back, I'll borrow back the other, right? I'll refi and borrow back my 50% down, but I'll buy it when no one else can buy it, and I'll get a ridiculously cheap price. And therefore, 10 years later, in the 12-year cycle, that asset is doubled and tripled. And then you're like, yep, time to unload this. The economy is doing great. It's booming, but I see a couple of cracks. This is overvalued asset, but there's more buyers than, so you sell it right? When people are like, hey man, I'm willing to pay way too much for this. Sweet, it's all yours. Give me your cash. Now they're asset light, cash heavy. The economy collapses, and now you own no assets, but high in cash and no debt. Right? You see, and the wealthy families, if you want to build legacy, and I do want to build legacy, they understand the cycle well. You don't buy a Rolex when things are good. You don't go into a Rolex store and buy a Rolex watch brand new right there at the glass counter because the economy is booming and you're like, my crypto stock, my crypto, I'm a millionaire, I'm going to buy a Ferrari, I'm going to buy a Rolex, I'm going to buy a beach house. No. Wait till the economy collapses and you can buy that Rolex watch for pennies on the dollar, the beach house for pennies on the dollar. The Ferrari, especially the guys that lease it. Oh, I'm willing to pay you $3,000 a month because I'm rich. Rich and stupid. The economy collapses. Dude, this is why you can go to Dubai. You can lease a car as an expat, meaning you're not from Dubai, you live in Dubai, and you're making good money, you're working for a hedge fund, and so you're leasing a Ferrari because, everyone's rich, you're doing well, everyone's a mover and shaker. So you lease a Ferrari and you're spending $3,000 or $4,000 a month on your car, just to lease the car, not maintain the car. Great. But then suddenly the economy tanks, your hedge fund tanks, and you don't have any money. And in Dubai, you're in deep doo-doo if you fail to pay your Ferrari payment. Like, it's bad. Here in the United States, you're like, yeah, I'll just go bankrupt. Yeah, in Dubai, they chop your hands off. So when hedge fund managers, when the white boys lose their jobs, they go to DXB, get on a plane, fly back to London or New York, and they leave the Ferrari at the airport. Well, buy that one. Buy that one. Yeah. That one's cheap, baby. So anyways, I like personal finance as well as corporate finance, as well as real estate finance, as well as, nonprofit finance, along with what we do as trading finance. I love the economic side of it. I love the behavioral side of it. I love what we do. So I know I went esoteric on you today. But now I hope you fully appreciate things like the yield curves. Yeah, all right, FX Brian. What does happen if you default on a lease payment? I know they don't chop your hands off. But I had forgotten. But a friend of mine in Dubai, somebody owed him money. He went through the court system, and sure enough, the courts favored in my friend. So he and officer of the court, like a police officer of some sort, a sheriff, a sharif, they went to the guy's residence that owed him money, and they're like, you owe whatever money it was, $500,000. Like, no, right now, we're here to collect the 500,000, and if you don't pay them off to be satisfied, you are going to jail right now. And so they went through his house, picked up. He got that G-Wagon, the Mercedes G-Wagon squared. It was like a G65 or AMG 65 G-Wagon squared. So that was like a $300,000 vehicle. And then he had a Mercedes S convertible, S65 convertible. Not the little one, the big one. And a bunch of Rolexes and a whole bunch of other stuff. And just walked out of the guy's house that day. And we're like, okay, we're squared. So now I want you to see business cycles, and I want you to read more and more what the cycle we're in by looking at the Treasury curve, which is the same of a cycle, right? So there we are talking about GDP versus potential GDP. But look what we have now. Okay, there's a bit of a curve going on, huh? What's going on? Well, over the last month, I've been freaking out about 4.5 and 5. I hope you pay attention to these things when I freak out. Oh, is that right, FX Bryant? Yeah, they block your immigration status so you can't fly out. So you get out as fast as possible, right? And you just like, you drive to the airport that day, right? You're like, oh snap, I'm not going to get paid any money this month. Oh my God, right? You're like, I need to make 25 grand a month to pay for my cars and my apartment and all this. And all of a sudden, no money. Yeah, you put an airline ticket on your credit card and you get the hell out before you default. And you just leave the car, you just leave everything. Just leave your apartment, just grab a couple of suitcases. Yep. And you're just gone in the middle of the. And it's not uncommon in Dubai. Okay. So, anyways, going back to this. Do you remember when everything that's green today, do you remember when it was massively red? I hope you remember these things. And I was telling you that the psychological level of 5 and 4.5 is massively important. And I started to teach you how insurance companies and pension funds manage their 30-year liability. And that they have their magic number. We call it a hurdle rate. They're like, hey, we got a 30-year risk, and our models show that we need about 5% to offset our risk over the next 30 years. And here we are. And this was 5.1. And this 30-year was giant red. I'm like, you need to watch for this to go from red to less red to a little bit green to massively green. It shows buying. What does it also mean? There's a bottom in the treasury market. Because yields are falling, that means the price is rising. This is buying action. That's why it's green, bro. And what's theirs? Okay. We're saying we're not so sure about the short run, but we feel really good about the long run. That's what it says. So where is that in the cycle? Well, that's for you to think about. How does this impact the business cycle? How does this impact the real estate cycle? What can we learn from the treasury market? That suddenly, just out of the blue, boom! Massive levels of money went into the treasury market. Hey, there was a time a year ago you didn't even watch this stuff. You had no idea that massive flows of money went into the treasury market. Well, is it useful information? You're like, I don't know, Wayne, I don't get it. Well, why don't you try to get it? Why don't you fight for it? It's not going to be handed to you on a silver platter. Fight for it. You have the data here. You have my help. You have Aiden's help. You know, we have very smart people that surround you. You don't need to go to Harvard for 5 years. 5 freaking years I went to Harvard. That's a lot, bro. You don't need that. But you do need to put in the effort and say, okay, well, this is interesting. That is an interesting thing. Money is suddenly flowing into the longer ends of the yield curve. What does it mean? Okay. Well, this might be a clue. See, I'm going to give you the answer because I'm a kind person. I mean, I'm smart and I'm beautiful, but the best thing about me is my modesty and my generosity. Let me tell you about all the amazing things about me. Yeah. The reason it was red before is they thought the Fed would raise interest rates. So if they bought a 5-year treasury 2 weeks ago and the Fed raised interest rate, well, the new 5-year treasury would pay more. So now I own a treasury that pays me less than a new treasury. Think of the behavioral finance of this. Would you buy a car if you thought it would be cheaper in 3 months? Okay, you're going to buy a car. You're going to buy it. You already know which one. And you know the price. And it's a fair price. But you're like, I think this will be cheaper in 3 months. No, doesn't matter why you think it. But you think. What's your behavior? Well, if it's only $50, you're like, nah, I'll just buy it now. If it was $5,000, yeah, Nissan is selling Nissan trucks. I drove by, I was out at a private gun club over the weekend, and way up there, I drove past a Nissan dealership, and they had $7,000 cash rebate or something. So imagine if you waited 3 months, it was $7,000 up. I don't know what a Nissan truck costs. $50? So $7,000 is, you're like, you know what? I can wait. I can wait 90 days if I can put $7,000, right? So it depends. So the value is less. Another way of thinking of it is you're going to lease this car instead of buying it with cash. Sometimes that makes sense. And you know that the lease percentage is based on the Fed funds rate. So you can lease it right now for 5%. But if the Fed cuts tomorrow, then your lease payment would fall. So you would not buy today. This is what's occurring in the Treasury market, and this is why we watch it. They've decided the Fed's not going to raise interest rates, will not lower the value of treasuries. So they're like, well, then give me my 5%. Boom! And they lock that in. Give me my 4.5. Boom! Give me my 4.25. Boom! Give me my 4 handle. Boom! And everybody buys what they want to buy. They bought the 4. They bought the 4.25. They bought the 4.5. They bought the 5.0. Boom, 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 boom. Locked in because they all decided the Fed's not going to raise interest rates this year. Boom! They're telling you the answers. When it was all red, they're like, dude, pretty high probability the Fed's going to raise interest rates. Now they're saying pretty high probability they're not, and therefore they're telling you with their money. This is signals and information by very large institutional investors taking on 10, 20, 30 years of risk, and they've made their decision by analyzing all this crazy, esoteric, complicated data with smart minds and smart computers and smart models and yada, yada, yada. And they just tell you the answer. It's right there. That's what makes you smart. And other people have no idea. But you know what the smartest minds in our economy, and by the way, some of this is foreigners, the smartest minds in the world, because what are they actually buying? U.S. treasuries? No, they're buying the U.S. dollar. Aha. They're also not just monetary policy, but implied inflation levels. There's a lot going on here. But we have a bottom in the treasury market. Now, sometimes this is bad, but sometimes it's good. It does show some level of vulnerability to the stock market fading. It doesn't say crash, but it's like, you know what? I don't want to be in the stock market. I want to be in the treasury market. Now, that's your typical model that you would learn in school. But it's not always the same. That's not always true. That's generically true. That may not quite describe what we have going on right this second. But what we do know for sure is money is going into treasury. So I think this has more to do with monetary policy than the economy crashing, because we can also see the economy is not crashing. And look at the change over 30 days ago. Beautiful stuff. Is that why insurance rates are so high? No, insurance rates are high because insurance companies took a bloodbath on COVID. Yeah, a global pandemic was not good for insurance companies. Okay. Yeah, like an example. My kids were in a club during COVID, especially at the beginning of COVID. They were in this club. And so I would attend, even before COVID, I would attend or drop the kids off and pick them up and do all the super dad stuff. And there was another dude, some other dad, and I never got to know him, but I'm like, he looks like someone that I would be a friend with. I'm like, look at him. He's about my age, about my height. He's got gray hair. He's handsome as a devil like me. And I'm like this guy. I'm like, dude, he looks like me. He could be my friend. I remember thinking that, but I don't have time for friends, and friends are terrible because all they do is let you down all the time. So I don't like friends. So I look at him though, and he stands out. He looks like another me. COVID comes along, and he dies of COVID. I'm like, wait, what? He actually died? Wasn't that old? He was healthy. I'm like, he died? I remember it really hit me. He's the only one that I know personally, my circle, that actually died. Now, I think everyone I've ever met, all my friends and all my family, got COVID. I never got COVID. I'm pretty sure I gave them COVID, but I never had a symptom of COVID. I think I'm a carrier, a super carrier. But he died. So he would have been about 50 years old, healthy, and he died. Guess what, Brian? Do you think he has health insurance or life insurance? I guess it would have been life insurance. He was also ex-military, so I'm sure there's benefits from the military. That's a payout. That's a redemption, so to speak, right? So take that across the world. Oh, yeah. And, bigger disasters, all that kind of stuff. They say the storms are getting bigger. I'm like, well, the population is also getting bigger. But nonetheless, yeah. That's why that was bad for business. So the hurdle rate, if you will, gets expensive, right? The hurdle rate. So it might be coming down now, but there was a time when maybe these insurance companies, because of their payouts, needed to make more like 6% a year on their float. That's what it's called, their float. So millions of people pay in a monthly insurance payment, but only hundreds get a claim. So millions of people pay for fire insurance on their house, but only 150 houses burned down. So there's all this extra cash just laying around. We call that the float, and they invest the float, and that's actually where they make their money. So the float hurdle rate, the hurdle rate is how much money do you need to make? Boom. It might have been 6, maybe now it's 5, and we can see this. And maybe it'll come down, or maybe it will go up. We'll have to see. So I'm trying to share today, because remember tomorrow's Fed interest rate decision. So you have all the data in front of you, right? Do you need me to tell you Bitcoin's at 66,000? Do you need me to tell you VIX is at 16? You can ask Aiden. I'm taking this opportunity to say, look, we have a lot of data here, and it's good data. It's fantastic data. And it's maybe in the beginning easy to be overwhelmed by the amount of data. No. Shh. Take it in stride. Take it small steps. And in this case, I'm using a story narrative. I'm telling you stories. Now, they might be lectures, but a lecture done right is actually a story. Because humans learn very well. We would sit around the campfire, and I would tell you the secret of life. So we went through business cycles and yield curves through a story narrative. And I want you to try to remember them. And don't worry. You know me. I'm going to tell you the story again and again and again and again, hopefully a few weeks in between. But we will revisit this because this is how you trade and make money. And once you store the information and remember the information, you can start to learn to read and apply based on your knowledge. If you can't remember it, it never happened. If you don't remember today's stories, then today's stories never happen for you. Now, I'll remember. And I taught myself this stuff. So I had to fight to remember it. One way I fight is to tell the stories over and over and over and over again, because I'm teaching myself as much as I'm teaching you. I'm reminding myself as much as I'm reminding you. We're creating positive trading and investing habits. And so, yes, we'll talk about real estate. We'll talk about insurance companies and pensions. Yeah. We'll talk about monetary policy. We'll talk about central banks buying gold and selling gold. Yeah. We'll talk about the supply and demand equation to understand what central banks can and cannot do. Because I'll tell you, if the greatest challenge with traders is there's too much information, the greatest risk for you outside of traders is misinformation. A lot of bad advice, a lot of bad analysis, and also lots of very simplified kindergarten, cotton-brained, ninny muffin, crayon economics and finance. Like inflation's high, Fed's going to raise interest rates. That's the one we're going through now. We've been hearing this for months, and I've been telling you it's stupid. And now we can see the market realizes, well, that's stupid. Well, good. But that's what you hear. I even hear it by experts. I'm like, holy schnickersnocker. This guy's got billions of dollars, and he has, Cambridge Community College level economics. Yeah. Not Harvard. Yeah. So, So you got to be careful. You got to be a trader. And you have to have the data, because we have to translate the data into trades. And that's a whole different thing. An economist typically doesn't do that. Yeah. But a trader knows, aha. But the challenge, I think, for us, once you get rid of the disinformation and now you have the information, the second thing is learning what it all means. Don't have to do it all today, but over the next 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 years, you're going to get better and better and better at your understanding, and you will get better and better and better at translating this not only into trends, and trends lead to trades, but then the time frames help you enter and exit. You will get better and better and better and better and better. So what can you day trade is the question. Boom, do that right there. Okay? So look at this one. Right now, we have a few bullish assets, but they're barely bullish. They're moderately bullish. 0.36, that's it. What about these ones? These are the sell ones. 0.26? Dude, there's no trade. What about oil? Oh my God. What about the stock market? Oh my God. Bitcoin? Meh. Silver? Meh. Gold? Meh. So look, to answer that question took 1 second. So maybe you're trading oil today. And you know what you do when the markets are quiet? You scalp oil. I've been teaching that forever. Evo. Look at wheat. Look at platinum. Look at soybeans. Silver, it's okay. Okay. Look at, dude, you need to be selling crude. Oh my God. Okay. That's it. And we're waiting for the Fed meeting tomorrow. So that explains why most of the markets are locked up. Slightly bullish. Okay. Slightly bearish. Look at the conviction. 1. It's bullish, but it's a 1. What about this? Bearish, it's a 1. That's the best you got? What about oil? Sell oil! Holy schnicker-snacker! So, look, you don't always have to have the long term. What we see right this second is the market's frozen, and we talked about this, I don't know, 2 days ago. The market probably being frozen. I think it was Monday. It was frozen like it is now, slightly up, slightly down. And I'm like, hey, what do you think the catalyst is? Maybe the Fed funds rate. Because remember, VIX was dropping, but right? But money needed to be deployed. Yeah. We could see it in the COT. So what to day trade? Just click the signal card or click trade avoid. Dude, done. What to trade? Boom. But that's just right now. You're like, well, Wayne, I want to see the bigger trend. All right, look at it this way then. Okay, if you haven't been selling CAD, you just don't know what's going on. Do you think CAD collapsing has anything to do with oil falling? Did you look at the correlation? Right? I don't even know if it's up here, so I should be careful. Did you even look? You're like, Wayne, I looked, but it's not there. Okay, yeah. And of course, we don't have CAD there, but be interesting. I should force it in on there. Okay, but anywho, I wonder if we can do it differently. How about, I wonder if I have CAD. Should be easier to reverse engineer this, huh? My mouse is going. CAD index. Ooh, is that what that is? Yeah. Okay. There's a positive correlation when CAD falls, oil falls, which is the same as when oil falls, CAD falls. I need to work on this, though. It's a cool page. I need to work on it, though. It's a little messy. My mouse is fighting me today, too. Well, I'm glad we had this. Yeah, that explains why not everything, but most things are sideways, right? But there's no doubt oil is falling. And there's no doubt treasuries that were collapsing are now rallying. There has been a catalyst. Okay? There has been a catalyst. If you go to position trades and we look at U.S. equities, they are up. Okay? 4% for the month, 3% for the week. Well, equities have been falling. We know this. They are no longer falling. On a position trade, like we were talking about, dude, if you're not selling CAD, I'm like, what are you doing? I like to trade euro dollar. What? That would be a dumb trade. Over the last 30 days, that doesn't make any logical sense. So if you don't have time to day trade, like let's put this into focus. You know, what's the bottom line here? You don't have enough time to day trade. You can't sit in your chair for 12 hours a day. You got a job, you got kids, you got family that needs taking care of. You just don't have the freaking time, nor do you want to. Then don't day trade. There's a theme going on here. The theme is CAD is weak. Probably has something to do with energy being down. Oh, really? Energy is down 25%? And you're trading euro dollar on a 15-minute chart? Like, what? Energy is down 25% this month. CAD is collapsing. And you're trading euro dollar. What in the world? So now you have data to help you make better decisions, but now you can look, maybe perhaps see the changes better and maybe stay in your trades longer. If you can't day trade, swing trade. If you can't swing trade, position trade. The definitions that I use, day trade is 24 hours or less. So you're using daily pivots. Swing, you're in it for a week or two, probably using weekly pivots. Position trade, you're in it more than a couple of weeks, maybe for the quarter, so a couple of months. So you're using monthly pivots. So find your timeline. Okay, if you had to be on CNBC today, and you're the Forex expert, if you didn't mention the pound strength and CAD weakness, and then maybe even be able to say the dichotomy, like maybe there's a change going on. Maybe. But look at right now. CAD is weak. We know in general, we just looked at it. It's actually the weakest. And it's down 0.1. 0.1. Forget about it. The weakest currency on the planet is New Zealand dollar. Remember, every time it's been strong, I said, well, we're bears. We're bears. We want to sell the New Zealand dollar. New Zealand dollar sucks. But for a week and a half, it was strong. And I'm like, yeah, but it sucks. I don't want to own this. It's going up. Great. Find a place to sell it. You want to sell it high. Do you guys remember all this? Now it's weak, but it's not very weak. 0.25, right? I'm not going to freak out about negative 0.25. So what's the real read here? Nothing's happening. So do you want to make a lot of money trading Forex? Yeah, stop trading Forex. Okay? What's moving is energy. Stock market, crypto. Risk on. But only on those. You think the stock market goes up on risk on? Well, that's what it's saying. We're risk on and the U.S. stock market's going up. Then you're going to be clever and say, well, which one? All of them, dude. NASDAQ, up 3. Dow, up 1.5. S&P, up 1 3/4. Yes, we track this in real time. Snap, 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 snap. You got to pick the right asset. You can have mediocre technical analysis and do fine if you pick the right asset. If you pick the wrong asset and you have mediocre technical analysis, you're going to lose money. If you have great technical analysis and pick mediocre assets, it's just not going to work out great. We've been all there. We've been there before, right? As soon as you bet on the horse slows down to a trot. You're like, what the hell? He was out there in the lead. And as soon as I put money on him, now he's trotting? What's he got? 3 bad ankles? What's wrong with that horse? Huh? Well, the problem is his name is Glue. Elmer's Glue. Elmer's Glue! Way out in the lead! Down the stretch they come! Hey, what's happening to Elmer's Glue? Oh no, he's falling back in the pack! Oh no! Elmer's glue is way behind. Yeah. Hey, dude, we've all done it. Yep. So anyways, I think that analogy is my signal to end the webinar. You're like, I love horses. How dare you do a glue joke? All right. So that's that. I want you to win. I want you to win big, but you need patience and discipline and a hell of a fighting spirit. And if you have all of that, you have a chance. I want you in 5 seconds or less to log in on your own without the Wayne. You can use Aiden. Aiden's fine. But you log in on your own and you're like, oh, there's nothing to do in Forex right now. So what should I do? Equities are up. Risk is on, but Forex ain't moving. All right, cool. Looks like I'll do some crypto, maybe flip some oil, do some skippity scalp while we tread water waiting for the Fed meeting. See, I need you to get there fast. And I need you to stop trading euro dollar because you like it. Like has nothing to do with that. Huh? You want like? Go adopt a puppy. Huh? You want to be a profitable professional trader? You got to do the work and you got to make better decisions. Because at this point, it's not a lack of data, and your technical analysis is probably good enough, right? So we're past all of this nonsense. Now it comes down to brain power. You have the data. What's your decision? This is the real world of institutional and professional investing. If you're going to be a hedge fund manager, people pay you to make decisions. What are you going to do, Haas? Fed's going to raise rates, but we're pricing out the December. Did you know? How does that influence your decision? What are we doing, boss? What's the plan? What's our strategy? Okay? I'm pushing you to be the boss. I hope you appreciate that. I do not belittle you by just spitting out my opinion. Who gives a hoot? Well, yeah, some do. You shouldn't, because you're becoming a trader. If I was trading your money, then you're like, yeah, but okay. But I don't trade your money. So I am building a boss. You. It's decision making that separates, right? Mediocrity from greatness, or at least survival. And so now we're right into the essence of everything. We focus at these meetings and our other meetings, your decision-making process. Because you shouldn't be sitting around going like, well, what would Wayne do? Or what is Wayne doing? To more like, what are you going to do for yourself, your clients, your loved ones, your family, your neighbors? Okay? Yeah. Significance. You need to be significant. And that requires significant effort, significant time, significant investment. But you have all the pieces. You have all the pieces now. Now, in our meetings, we focus on the decision. And that is going to make the difference. Now you have a chance to fulfill your destiny. And I am telling you, the world needs you to step up and be their champion. because this is a very difficult thing that everybody has a retirement account. Everybody gets old. Everybody needs to survive. Money is important to everybody. Money is important to survival. It might not buy you happiness, but it buys food and shelter and safety and comfort. When you're too old to even get out of bed, that Tempur-Pedic puts a smile on your face. And if you're at the next level, or you're generous, you take the excess money that you have, the excess wealth. Because if it's wealth, you can't even turn the money off. You understand that? If you're able to save $1 million, I can produce $100,000 a year forever. You can't even turn it off. Imagine you just gave $100,000 a year to charity. Every year, $100,000. Every year, because you put $1 million over in the side account and you're like, I don't need the $1 million. I'm just going to give my favorite charitable organizations $100,000 year after year after year after year. I'll give this one $1,000 a month. I'll give that one $1,000 a month. 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 And they will get that cash flow forever. And that $1 million always exists. You can't stop making money. Rich people spend all their money, and it's gone. So they need your help. This is bigger than you. This is bigger than paying the bills. This is bigger than buying a fancy car. Society needs you and is waiting for you to succeed. And it's your moral duty to take care of society if you have the knowledge. Harvard actually tells you this. They told me this. I'm telling you this. I'm giving you the opportunity for greatness. It's not going to be easy. It's going to be a struggle. And it's going to take a lot of time. But you owe it to yourself, to your family, to your friends, to your community, because you're capable and they are likely not. They turn to you and you've been trained to be a boss. You've been trained by me to be a leader, not a follower. Have a wonderful day. I'll see you tomorrow for FOMC. Peace on earth. May the pips be with you. May your profits be above average.
Ukrainian drone strike halts operations at Moscow oil refinery, sources say. U.S. housing starts plunge, 15.4% in May, much more than expected.
Exclusive Binance set to lose EU license bid. Permission to offer services in the bloc, sources say. Market sentiment remains tethered to U.S.-Iran peace deal.
U.S. dollar Canadian dollar back above 1.4 thousand and running away from support levels. Gold holds firm above $4,300 with Fed decision. U.S.-Iran deal in focus.
Gold inches higher as rate hike wagers ease amid U.S.-Iran deal hopes. Euro limited upside versus dollar, NBC. British pound recovers as Japanese yen struggles to capitalize on Bank of Japan's hawkish rate hike. They're dunking on the oil bulls.
Silver rises on US dollar weakness as markets eye Fed decision. Latin America's trade with China surges, but U.S. dominance holds, IDB finds.
The RBA rate decision, rates yunch, did little to break the Australian dollar-US dollar one way or the other.
U.S. import prices surge 1.9% in May, much more than expected. 1% rate, 160 yen. Why Japan's historic hike changed little. Nasdaq falls as some of the momentum names reverse. SpaceX gives back some gains. Semiconductors struggle as financial and consumer sectors shine.
Australian dollar gains after hawkish RBA hold as focus shifts to Federal Reserve. Colombia retail sales year over year above forecasts, 11% in April, actual 14.9%. British pound holds 1.3400 as Fed's decision looms.
crude oil down sharply and tests a swing area target. Ripple price forecast, XRP struggles below 50-day EMA resistance. New Zealand GDT price index dipped from previous 0.6% to 2.8%. Dow Jones Industrial Average races to records as Warsh eyes the punch bowl.
Trump says memo states clearly Iran will not have a nuclear weapon. Qatar Energy reportedly ready to restore LNG output within a month.
Japanese yen fails to gain support after BOJ hike. The euro already hiked. Now it waits on Warsh. Canadian dollar holds near recent lows as soft oil, Fed uncertainty lift US dollar Canadian dollar.
WTI plunges as U.S. lifts Iran sanctions on oil sales. WSJ
Oil falls further on a report that Iran could be allowed to immediately sell oil.
Nasdaq corrects lower in trading today, but backs into support target area.
Binance risks losing EU market access under MiCA rules.
US dollar Swiss franc price forecast. Upside momentum fades after rejection at 0.8000.
The US dollar is moving lower, except against the yen.
Materials stocks shine again. TSX remains firm after hitting new high. Crude oil sells the Iran peace deal sight unseen. WTI hits 15-week low.
XRP fragile rebound weakens under 50-day EMA. U.S.-Iran deal allows Tehran to immediately sell oil upon signing, says U.S. official. United States 20-year bond auction down to 4.927% from previous 5.122%.
The U.S. Treasury sells $13 billion of 20-year bonds at a high yield of 4.927%.
20-year bond auction attracts above-average demand. Exclusive: the U.S. is using an Iranian smuggling tactic to sneak oil out of the Gulf. Major European markets close higher.
$4,000 or $4,500? The Fed may decide gold's next big move. Oil prices fall 5% to 3-month low on hopes Strait of Hormuz will open.
WTI Midland crude oil differentials rise in European market.
Gold ticks lower amid tomorrow's Fed rate announcement, profit-taking. Fed Preview. Warsh walks into a minefield. A look at early stumbles of other chairmen. Hezbollah believes Iran will not sign final nuclear deal if Israel stays in Lebanon.
Swiss market ends higher again. Silver price forecast. Silver US dollar clings to 200-day SMA as Fed takes center stage.
Or P pulls back as subdued ETF inflows, layered resistance cap upside.
Australian dollar price forecast. Caution prevails ahead of Fed. Crude oil nosedives on U.S.-Iran. Peace deal. U.S. permission for Iran oil sale. Crude oil futures settled at 76.5. Australian dollar slips as RBA pauses but keeps hawkish bias.
Gold test 61% fib resistance at 4370 hourly levels. Gold climbs as oil rout softens Fed hike bets.
U.S. stocks move to new lows. The Nasdaq index approaches its 100-hour MA support target. Arabica coffee futures climb 5.2% on Brazil harvest worries.
Forex.Today. U.S. dollar stays neutral as markets await Warsh's first Fed decision.